Welcome, ladies and gents, to the webcast today, Replicating Private Equity with Liquid Public Securities. We'll be starting the webcast in 5 minutes. today's webcast, Replicating Private Equity with Liquid Public Securities. I'm your host, Julian Klamachko. We're going to keep this one relatively brief. I think we can get it done in 20 minutes, and then I'll go on to a Q&A section. So anytime you have a question, feel free to type it in, and I will address that at the end. But let's get into the presentation today, Replicating Private Equity with Liquid Public Securities. Now, to start off, I want to define what is private equity. Well, when we mention private equity, what we're really talking about here are leveraged buyouts. It's a long-only asset class where investment firms, they buy typically small cap companies at low EBITDA multiples, and they apply a copious amount of leverage, hence the L in LBO. This type of strategy is heavily favored by institutional investors, and the main reason is due to its historically high returns. Check out the disclaimer here, of course. So to start, now that we know what private equity is, we're going to talk about what everyone joined on the webcast for. That's private equity replication. Now, what private equity replication is, it's an investment strategy that was basically discovered by Harvard Business School a number of years ago. And so this is straight from the white paper that they put out in 2016. It stated that a passive portfolio of small, low EBITDA multiple stocks with modest amounts of leverage and hold to maturity accounting of net asset value produces an unconditional return distribution that is highly consistent with that of the pre-fee aggregate private equity index. So basically, they disclosed a special formula for replicating private equity returns utilizing liquid public securities, and specifically, it's three main factors that go into an investment process that can allow an investor to replicate private equity with liquid public securities. And those three factors consist of small cap stocks. The second one is value, so low EBITDA multiple stocks. And the third, the secret sauce, is leverage. And so those three factors or characteristics are basically what define the returns produced by private equity. And you can attain those three factors on private asset side or the public asset side. And where we're going to focus on our public equities. So digging into these three factors or three characteristics that make up our private equity replication formula, we'll see why this strategy works. So our three-factor model, to recap, is size, value, and leverage. So to start off with the first one, size. So in our model, we would own small capitalization stocks. And the reason being is that historically, small cap stocks have outperformed quite significantly. There's a ton of academic research basically proving this theory that small cap stocks have historically outperformed. This is known as the size anomaly, and this is the first factor that makes up our three-factor private equity replication model. The second is the value factors. So historically, leveraged buyouts have transacted, they have acquired small companies at low EBITDA multiples, typically kind of 8 times EBITDA and lower. The reason why is that historically low EBITDA multiple stocks, low valuation stocks have outperformed on average over the long term. There's a copious amount of research on the value factor. This is known as the value anomaly, such that value stocks historically have outperformed the market averages. So thus far we have size, small cap anomaly, value, low EBITDA multiple stocks, and lastly, private equity's secret sauce is leverage. Now, leverage amplifies returns, positive or negative. So we're basically amplifying the size effect and the value effect in order to generate basically, high historical returns, high future returns, as private equity has done. So if you're really looking to craft an investment strategy that can generate market-beating returns on a go-forward basis, really without any concern about volatility, then this is really it, our private equity replication formula that combines size, value, and leverage. So now that we've discovered and gone over the formula for replicating private equity returns, and we're going to get into the results of that formula in comparison with traditional private equity returns, I want to go over three main reasons why one would want to replicate private equity with liquid public securities instead of accessing the asset class as does the average institutional investor. Well, number one, we do want to replicate private equity returns, just given they have been historically high and significantly higher than the broad-based market averages. And so private equity returns are desirable, and that's why we've seen a flood of capital into the space. Institutional investors are allocating more and more of their portfolios to private equity with the goal of generating greater returns than what's available in traditional asset classes. The second reason to replicate private equity is to generate those returns, but at lower fees. Traditionally, private equity fees have been the 2 in 20 model, which is described as a 2% management fee plus expenses, plus a 20% performance fee or carry. Now, this adds up and can be as high as 7% per year, which is a significant fee in the age of near zero fees for index ETFs. So if we can get these private equity returns at substantially lower fees, then that's a good thing. And lastly, the third reason, better liquidity. So traditional private equity has lockup periods of 7 to 10 years, meaning once you invest, you can't get your money out for at least 7 to 10 years, if that. They basically give you the money when they're done liquidating all the fund assets, which is, a significantly long time. And that illiquidity, in my opinion, is a negative thing for investors. I think investors should have the right to get their investment back when they want it. So private equity replication gives that liquidity. It basically, you can get intraday liquidity, get your money back any day you want when you replicate private equity with liquid public securities. So we're going to dig down into these three reasons why one would want to replicate private equity with liquid public securities. So the first reason is just basically the returns. What we're looking at in the graph on the right, so there's three lines. The first is the green line. This is the Cambridge Associates Private Equity Index. It's basically a composite of hundreds or perhaps thousands of leveraged buyout funds. So real money funds that are investing in the traditional private equity sense. So this gives you a sense of historical private equity returns in the green line. Now, the gray line represents the S&P 500 broad-based equity index, also known as the market. And the purple line is our private equity replication strategy, small, cheap, and levered stocks. Now, this was produced by an independent firm, Factor Research, produced good work. It's not one that we did ourselves. However, we have generated the same studies and gotten the same results. We just thought it'd be better coming from an independent source. So what this graph is showing two things. Number one, the purple and green lines line up very, very similarly. This shows that the purple line, our private equity replication strategy of small, low valuation, leveraged stocks, matches the return profile of the green line, which is our private equity index, which is exactly what we want with our private equity replication strategy. And number two, our traditional private equity returns in the green line and our private equity replication returns in the purple line significantly outperform the market. As you can see, the gap above the gray line, the S&P 500. So that's something to keep in mind. Two main points there is that, yes, our replication strategy works, and yes, historically, private equity has outperformed public equities, the broad-based S&P 500, which is why there's so much demand for traditional private equity. Next up, we want to talk about the second reason to replicate private equity with liquid public securities, and that's lower fees. So if we talk about the fees in traditional private equity, they're high. The management fee, typically 2%, which is some of the highest out there in terms of asset managers, a 2% management fee, but that's not even all. Private equity firms also generate performance fees or carry on their investments, which are typically around 20%. So it's that 2 and 20 model where these fees can add up to as high as 7% on an annual basis, which is quite significant. So on slide 8, we look at a graph produced by CalPERS, and CalPERS manages hundreds of billions of dollars. They're one of the largest pension funds out there and a large allocator to private equity. And what this graph is showing that over a 20-year horizon, their private equity portfolio produced the highest net return, 12.3%, the blue bar, but it also charged significant fees. So private equity on a gross basis, i.e. before fees, almost generated 20% annualized, which is a pretty exceptional return. However, if we look at that red bar, private equity charged 7% on an annual basis in fees, which is substantial. That's over a third of the investment returns, and an incredibly high fee when compared to the 4 basis points charged on their public equity portfolio and the 1 basis point charged on their fixed income portfolio. So you're talking about many, many multiples higher of fees on traditional private equity, which in my opinion is one of the main reasons why we would want to replicate private equity returns with liquid public securities, so we can do it at a substantially lower fee than 700 basis points per year. Thirdly, we wanted to talk about liquidity. And one thing that people think is a feature of private equity is its illiquidity, because given traditional private equity assets, their investments do not trade easily. They don't trade on public exchanges. They're held by the private equity firm, so they do not get marked to market like stocks and bonds do on a daily or intraday basis. What traditional private equity firms do is they mark to model. They basically can make up what their assets are worth irrespective of what public markets do. And so what these mark to model valuations can lead to is understated volatility and an unrealistic smoothing of returns, which is what happens when you can pick and choose what the underlying valuations are instead of, being put up to the test by the discerning public markets on a daily basis. The most surprising thing is if you look at the private equity index, it rarely goes down. Well, I guess that's unsurprising, but it displays volatility below 10%. And if you look at the standard deviation of the S&P 500, it's typically in this 15 to 16% range. And really, a sub 10% volatility for traditional private equity really makes no sense, because traditional private equity companies are typically leveraged, so with debt north of 6 times EBITDA, while public equities are less than a third of that. And as we know, leverage amplifies returns, it amplifies risk, it amplifies volatility. So if private equity is 3 times as risky, it's kind of hard to justify a volatility that is less than 2/3 of the less risky public markets. But I digress. Investors shouldn't be fooled by mark to model. They should assume a significantly higher volatility, significantly higher risk level with traditional private equity, which we can observe in our private equity replication strategy, because it is a risky, volatile strategy, but that's really what it takes to generate those high long-term returns. So in our opinion, liquidity is a feature, not a bug, and it's worthwhile trading the mark-to-model returns for mark-to-market, which you do have to withstand higher volatility. However, you get to save significantly on the fees. You won't be paying that 7% per year anymore. So some smart institutional investors have really caught on here. If we look at the Yale endowment, they're one of the largest allocators to private equity. They're running well north of $20 billion. A significant portion is allocated to private equity, but they don't really believe the mark-to-model valuations and smooth returns of traditional private equity firms. So what they do, they have an underlying volatility assumption what Yale does is, if you look at their annual report, they assume the volatility or the standard deviation of their private equity investments are 23.6%, which is significantly higher than the disclosed assumption for their domestic equity portfolio of 18%. And traditionally, the S&P 500 has had standard deviation of about 15 to 16%. So you have highly sophisticated institutional investors such as Yale, assuming that their private equity portfolio is about 50% higher in volatility than the S&P 500. So that's really something to keep in mind. Don't be oblivious to the mark-to-model returns produced by private equity. Understand that those are understating risk, they're understating the volatility, and that true risk and true volatility of those strategies is significantly higher. And we can see that with our private equity replication strategy that utilizes liquid public securities, which are in fact marked to model on an intraday basis, which is really the most honest way of marking your portfolio. You have tens of thousands of independent investors marking those assets on a daily basis, as opposed to the one private equity firm marking up their own assets to the model, basically picking and choosing the returns that they would like to get. The last thing I wanted to touch on is the notion of the illiquidity premium. So if you are a private equity investor, or if you follow the asset class, you would hear about this thing called the illiquidity premium, which is defined as the extra return an investor receives due to an underlying asset's lack of liquidity. And lack of liquidity means that the owner isn't able to sell the asset easily. So if you have two assets that are economically equivalent, but one is more difficult to sell, then in order to hold the more difficult to sell asset, you would generally want a higher return because it is riskier if you need the capital. Sometimes you won't be able to cash out because it is illiquid. So this illiquidity premium exists in certain asset classes. However, it traditionally doesn't exist in private equity, and here's why. So if we look at the graph on the right, this shows assets in private equity have gone from about 300 billion in the year 2000, and it really exploded to about 2.5 trillion as of last year. So there's been a massive flood of capital into private equity, which, as we can see on slide 12, has led to record buyout valuations. So we got to understand where this illiquidity premium comes from. And this illiquidity premium is defined as the premium return that we earn on illiquid assets. But historically, this illiquidity premium is earned from the discount and multiple in which we can buy an investment at, right? So historically, if we look at the graph on the right, there's two lines here. The first one, the red line, is private equity buyout multiples. And so if we look at the left vertical axis, these are EBITDA multiples. So basically valuation multiples where private equity leverage buyouts have been done. So if you look between 1996 and 2014, buyouts were typically done between 6 times EBITDA on the low end and 10 times EBITDA on the high end. Whereas after 2014, as more and more capital started flooding the space, buyout multiples increased dramatically from that 6 to 10 times range to now 12 to north of 17 times over the past couple of years, 17 times EBITDA. That means they're paying nearly 3 times the valuation multiple that they paid 10 to 20 years ago on average for the average leverage buyout. And as all investors know, the main driver of future returns is purchase price paid. And getting back to the illiquidity premium, this is shown in the chart as a discounted multiple to what public equities were trading at. And public equities here are shown in the blue line, being the Russell 2000. So between 96 and 2012, the Russell 2000 traded at 10 to 12 times EBITDA. So if you look at private equity, where they're owning these private assets, they were buying them at substantial discount to the market, typically 2 to 4 turns of EBITDA cheaper. And that is exactly where this illiquidity premium came from. Since they're buying these assets, they're holding them, they can't sell them for a long time, they are illiquid, they can pay lower multiples for those. And by paying lower multiples, they can generate higher forward returns. However, with that flood of capital and the massive increase in private equity buyout multiples paid, as shown in the red line, now north of 17 times, they've actually exceeded the multiple of public equity securities. So really, the conclusion of this graph here is that the illiquidity premium has actually turned into a discount, such that investors, since they're now paying higher prices for private assets, they can assume lower go-forward returns from private assets as compared to their liquid public equity brethren. So that really lends credence to the liquid private equity replication strategy using public securities, just given you can buy cheaper assets based on EBITDA multiples than we're seeing in the traditional private equity leverage buyout space. So the main point here being private assets now trade at premium valuations, and the illiquidity premium has now turned into a discount. That relationship has flip-flopped such that traditional private equity returns, which historically have beaten the market, are expected to underperform on a go-forward basis. So in conclusion, private equity replication with liquid public securities can offer returns comparable to that of traditional private equity, but with better liquidity, and they can also do it at a fraction of private equity's high cost. Not only that, but it's available to all investors, not just accredited investors, with no investment minimum. So, you know, any investor can allocate to private equity in their asset allocation framework. You don't have to be the Yale Endowment or CalPERS to get a piece of private equity returns. Basically, anyone can do it through private equity replication with liquid public securities. But there are trade-offs. So the trade-off for lower fees and better liquidity is the liquidity can damage investor returns at some point. If we look at what happened in Q1 2020, returns were rough for basically all asset classes, especially levered small cap value. And this spooks a lot of investors such they sell out at the wrong time. So the volatility really gets to some investors, and they end up selling at the lows and not being able to harvest those long-term market-beating returns. So they can get spooked by the mark-to-market reporting and the inherent volatility of the strategy. And that's where mark-to-model and the illiquidity of traditional private equity can save investors. Instead of panic selling, they're actually locked in and prevented from panic selling at the lows. So that's one trade-off. So given those considerations, investors that are seeking to utilize private equity replication strategies, they must take a long-term view, be cognizant of the risks and the volatility, and really allocate a small portion of their portfolio such that they can manage through the volatility and don't end up selling at the lows, say in Q1, where there was a large drawdown. Nonetheless, to conclude, we have our private equity replication strategy, as proved by many other firms and academic research. Small cap plus value plus leverage is the secret sauce, the secret formula for attaining private equity returns. So traditional private equity returns, which have historically only been reserved for billion-dollar endowments, institutional investors, and high net worth family offices, they can be replicated by any investor with leverage small cap value stocks. So that concludes our presentation for today. Hope you enjoyed it. I will now go on to the Q&A period. So the first one, I don't really know what private equity investing is. Never mind why I should be replicating. Key opportunities and risks. Well, private equity refers to leverage buyouts, which is a long-only asset class that has historically outperformed the S&P 500 and other broad-based equity strategies such as that. So it's favored by institutional investors that are really seeking higher returns. So that's basically the opportunity set in private equity is seeking higher returns. The risks, we touched on it a lot in this presentation. The risks are really just higher volatility, bigger drawdowns, and so you really got to just take a long-term view to harvest those long-term market-beating returns. So next question, talking about the value factor, what are your preferred metrics? Well, historically, the private equity industry has relied on EBITDA multiples. That really drives the industry. And the lower the EBITDA multiple, the higher the future return. That's basically, the formula for future equity returns. So that's something to keep in mind. EBITDA is basically a loose proxy for cash flow, heavily relied upon by private equity firms. So that's the one that we prefer to really replicate private equity returns. Another question, has the popularity of the value factor pushed some value stocks out of the category, leaving less quality names for value? I don't think that's necessarily the case. The value factor really hasn't worked very well over the past 10 years, which if you look at basically the spread versus growth stocks or glamour stocks, it's at one of the widest points in history, comparable to that of 99-2000s, where you had this big rally of growth stocks in the late 90s and value stocks basically did nothing. And then over the next decade, that relationship really reversed, where you had a tremendous outperformance of value stocks and significant underperformance of these growth or glamour stocks. So that's something to keep in mind when looking at the strategy. Can you elaborate on mark-to-model versus mark-to-market accounting? Sure. Well, mark-to-market is very simple. You basically take your portfolio holdings and see where your public equities closed on any certain day, and that's the value. That's where you mark it, right? If you want to mark-to-model, you can basically pick where you'd like to value your private equities because they don't trade anywhere. If you want to value it at cost, you value it at cost. If you want to assume that the value went up 10%, and so you mark it 10% higher. They're granted a lot of leeway, private equity firms, on how they value their assets. However, regulators are starting to crack down on that, making it more difficult to do. But nonetheless, they do need to make up a valuation, but they do need to start to justify it. So how do you define small cap stocks? So we define small cap stocks as anything below 5 billion. And this is a moving target as companies in general become larger and larger as the economy grows with inflation. The definition of a small cap stock traditionally grows and grows. A while back, small cap used to be less than $1 billion. And you didn't have any public companies worth more than 100 billion. Well, now you have a couple public companies that are worth more than $1 trillion. And so you need to move the goalposts. So at this point, we define small cap stocks less than 5 billion. Would you try to take control position or a majority position with a small cap company like PE? Well, I should mention the fund that we run is the Accelerate Private Equity Alpha Fund. It is an ETF. So from Accelerate standpoint, we would never take a control position because our private equity replication strategy is structured as an ETF with intraday liquidity. So we got to be cognizant of the underlying liquidity because we give our ETF investors a liquidity. So we don't want a mismatch, an asset liability mismatch. We need to be able to honor the liquidity of the ETF. So basically we structure the investment such that we could liquidate them all in one day if we needed to. So we keep our position sizes quite low at this point. How do you manage the leverage in the strategy? There's a number of ways of doing it. The way that we do it specifically, and there's nothing wrong with other ways. Some firms target stocks with higher leverage inherent in the company. The way that we do it is we actually apply leverage at the portfolio basis. So our alpha strategy is 130% long. So we lever our longs and we hedge that back to 100% net long with 30% short position in S&P 500 futures, just to try to mitigate some of the volatility there. But we don't necessarily target a specific volatility. This is a high risk strategy. We set expectations with investors that, look, if you want to get private equity returns, either through replication or traditional private equity, it's a very risky strategy. It's a high risk strategy, significantly more volatile than, say, the S&P 500 or other broad-based equity benchmarks such as that. And so it's a strategy that we're really looking to generate high long-term returns, really without an attempt to manage volatility. It's not like a traditional hedge fund where you're looking to target volatility or manage volatility in a certain way. How would you implement this strategy? Well, we filter, rank, and screen all 4,000 liquid public North American securities and rank them according to our three-factor model. So basically filter out larger stocks, so we're basically looking at anything below 5 billion and above 100 million, such that they have certain liquidity constraints, really targeting those small capitalization securities. Then after that, we look at, or we rank them by valuation. So we're looking at EBITDA multiples here, ranking them into deciles, and we select the portfolio securities from the top decile, the cheapest stocks on an EV to EBITDA basis. From there, we apply additional other filters, looking at quality and looking at certain risk metrics, such that we're trying to screen out potential securities that are going to go bankrupt or things of that nature. We're really targeting the high quality value stocks to help mitigate some risks. We also apply various sector and risk mitigation metrics. So really trying to have a broadly diverse portfolio such that we're not allocating too much to any specific sector and any specific stock. So position limits, sector limits, risk limits, etc. And then from there, we select the securities, apply a bit of leverage to get to 130%, and then we execute the short of the S&P 500 futures 30% to get the net exposure down to 100%. So we have that small cap value stocks that are leveraged. We rebalance this on a monthly basis. And it's 100% systematic. Next question, where does this strategy fit in my clients' portfolios? Do I view the equity allocation as a whole or treat private equity as an alternative allocation? Yeah, historically it has been an alternative allocation, but the thing that is somewhat misunderstood with respect to alternatives is they span a wide myriad of strategies, each one with a very specific mandate. If we look at something like private equity, its goal is to generate high returns while taking a lot of risk. I mean, it is a high risk strategy. So on the alternative side, it would be one of the higher risk strategies along with venture capital. No one really manages risk in venture capital. They're looking to generate the highest returns really with no real attention paid to the underlying risk or volatility. On the opposite side of the alternative spectrum, you have certain arbitrage and market neutral strategies where they're looking to generate singles, not home runs, looking to generate single-digit annualized returns with very low managed volatility. And there's all sorts of alternative strategies that are in the middle, kind of medium risk strategies, whether it's risk parity, CTA, long short equity, distressed debt, things of that nature. So when looking at an alternative allocation, make sure that it's diversified across various alternative strategies, everything from low risk to medium risk to high risk. In the high risk bucket, I would lump private equity in addition to venture capital and comparable strategies. And so that's really where private equity replication strategy would fit in. While some endowments allocate pretty sizable chunks of their portfolios to private equity as high as 20% or higher, just given the risk profile, I'd advise investors to keep this allocation sub 5%, just given that they won't be spooked by the volatility and the drawdowns and be able to really stick with it over the long term, which is needed to generate those high expected returns. And that's basically it for questions today. Thank you for attending our presentation on replicating private equity with liquid public securities. Hope you enjoyed it. Hope you learned a lot. Feel free to reach out. Here's my contact information. Give me a call, flip me an email if you'd like to learn more. And I hope you stay safe, stay healthy, and have a great day. Cheers.